What's up, everyone? It's Scotty with MoneyVest. So we had the inflation numbers coming out earlier today, about exactly 12 and a half hours ago. We had the inflation numbers. I did a live stream during that time to go over all the numbers, and we also talked about the market's reaction and how it's going to become increasingly difficult for shelter prices, for inflation numbers to now make this last leg lower from 4% down to as low as 2%, which is what the Federal Reserve's target really is. So I'm going to break down. We've got lots to unpack in this video. As always, if you enjoy it, find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. And of course, link to our Discord and Patreon is going to be down below if you're interested in joining us and of course being a part of our MoneyVest community. Again, I did open up a couple more spots in October, and you will get access to all the Excel spreadsheets that are available to download. You'll get access to members-only private videos that you can watch at your own free time, and you will get access to the MoneyVest stock reports, and not to mention over 18 to 20 private Discord channels, including buy and sell alerts, options alerts, trade ideas, and everything's going to be included with the link down below, and we'll love to have you on board. And there's a lot of analysis and a lot of discussions that are happening on individual companies as well that you can access through Discord as well. Now, going over to the markets, the state of the markets, the Dow Jones here dropping over 76 basis points, the NASDAQ and the S&P also rolling over here pretty aggressively. We were drifting a little bit higher after the inflation numbers came out. We did drop, then we recovered a little bit. And then we rolled right back down. We did have over 1,900 stocks down between 0 and 2%. Another 1,600 that were down between 2 and 5%. And overall, we had over 4,500 stocks that were declining on the day, with about almost 1,000 stocks that were neutral and just about 1,400 stocks that were advancing and green on the day. So here are these CPI numbers. Month over month coming in a little bit hotter than what the expectations were at 0.4%. Year over year coming at 3.7%, which was a little bit higher than what the consensus was and in line with the previous number. And core CPI, when you exclude for food and energy, coming in at 0.3% month over month and 4.1% year over year. That was in line with what the consensus really was from the market. So we got two numbers coming in hotter than expectations, two numbers coming in line with expectations. So overall, it was a bit of a mixed report. But if you really break it down into some of the categories that were released, which I'll go over in just a minute, energy prices higher, especially fuel oil, up over 8.5% month over month, which was not a surprise, something that we were talking about in our previous updates. And the shelter prices were up 0.6% on a month-over-month basis. I think this is really where a lot of the problem lies, and that is going to be in the real estate market, more specifically shelter and rents that are not really coming down. And in fact, we did a poll with all the members. We had over 600 people, 700 people watching earlier today in our live stream, and I asked everyone, right? If you are a homeowner, if you are a real estate investor, if you are a tenant, what are you actually witnessing in the rental market? And everybody mentioned the rents are going up. They're not going down. Not a single person I think I can remember said their rents are indeed lower. They all pretty much mentioned their rents were higher from same time last year, and they are consistently going up as property taxes around the country has risen, not to mention that interest rates are at an extreme level at over 7-8%. We haven't seen these rates in over 23 years, and because of that, the gap between the actual buyers and sellers, the gap is the highest that we have seen in a very long time. And as I mentioned during the live stream as well, I was on the call with one of my friends who's a real estate agent in the East Coast, and he mentioned that the sellers are not willing to budge. In other words, they're too stubborn to lower their prices. And on the other hand, the buyers can't afford such high prices given how high the interest rates are. So there's the biggest gap that we've seen between buyers and sellers when it comes to real estate. So that, I think, will need to resolve itself over time before we start to see rents falling over. And that's one of the reasons why I've mentioned before that it's a lot easier. It's significantly easier for the Federal Reserve to bring inflation down from 9 to 4%. But this last leg, right, which is the last sort of mile, basically coming down from 4 to 2, is the most difficult thing because prices tend to be stickier in certain areas more than others. And for that reason, it's going to be a challenge for the Federal Reserve to really really bring inflation down to 2%. And this was an article that came out earlier today. So getting to 2% inflation won't be easy, and this is what will need to happen, and it might not be pretty. So in theory, getting inflation closer to the Federal Reserve's 2% target doesn't sound terribly difficult, and it doesn't, right? In theory, it doesn't. The main culprits are related to services and shelter costs, with many of the other components showing noticeable signs of easing. So targeting just two areas of the economy doesn't seem like the gargantuan task compared to, say, the summer of 2022, when basically everything was going up. In practice, though, it could be harder than it looks, and prices in those two pivotal components have proven to be stickier than food and gas, or even used cars or new cars, and all of which tend to be cyclical as they rise and fall with the ebbs and flows of the broader economy. So that's exactly my point. Some prices, especially services, shelter cost, they tend to be a lot more stickier than that of food and gas. They tend to be more volatile. And this right here was Stephen Blitz, a chief of U.S. economist at Global Data TS Lombard, and he says, and I quote, "You need a recession. You're not going to magically get down to 2%. And that's the whole idea, right? I mean, getting down to 2% is going to be tough, and we've talked about this. I think I mentioned this like literally 6 months ago, 8 months ago in one of my videos, where getting down from 9 to 4, easy. Getting from 4 to 2, incredibly difficult. And in order to get down to that level, I think there is a very good case to be made that overall consumer spending just needs to come down, and rents needs to come down. And a lot of the stickier items, energy prices we've already discussed, but food prices and apparel, right? A lot of the components on inflation need to roll over, and a lot of these things will come down if there is a recession. And look, that's unfortunate, but it's kind of, again, in one of those situations where bad news for the economy ends up being good news for the market, because the sooner inflation gets down to 2%, the sooner the Federal Reserve is going to start looking at cutting rates, and that will eventually lead to some quantitative easing and a very significant bullish catalyst for the market. Now, there was also a discussion in the market live stream that we had. There was a very interesting question from Tristan. He basically asked, is the Federal Reserve's rate cuts are going to be bullish for the market, right? Even if they do start cutting rates eventually, is that going to be bullish for the market? Well, the short answer is yes. The long answer is it's not so easy. It's a little bit more complicated, because the only reason why the Federal Reserve starts cutting rates in the first place is if there is some type of a problem, right? There's a problem they're trying to fix, right? Every time you go back, every time the Federal Reserve's cut rates, they're fighting either recession or deflation or both. Right now, we don't have anything, right? We don't have a recession. We don't have an economic recession. The labor market's too tight for that. We don't have deflation by any means. Inflation's still stickier. So there is no reason, there's no incentive for the Federal Reserve to start cutting rates just yet, right? That's why I've been a little bit more on the fence. I've been like, okay, maybe the Federal Reserve can raise interest rates maybe one more time, another 25 basis points is a possibility, although market disagrees, because the market's pricing in a pause all the way through the end of the year, and they're expecting cuts next year. Now, again, we'll find out, considering how tight the labor market is, considering how stickier the inflation is. I don't think the market's correct, but again, I could be wrong, and the Federal Reserve may end up pausing for the rest of the year and start cutting in 2024. But the idea for cuts is very much that they need an incentive. They need something they need to fix, and until we get that, right, they're not going to. In my opinion, they're going to keep rates higher for longer. Maybe they don't hike. Maybe they keep them where they are. But they are going to keep them where they are for longer until inflation is down to their target, because they're very, very adamant, they're very persistent, and they're not taking their foot off the gas until it comes down to 2%. Because the last thing they want to see is a double top on inflation, similar to what we witnessed back in the 1970s and 1980s, the great inflation of 80s, where inflation was up, it came down, the Federal Reserve eased back a little bit, and then it spiked right back up, right? So the last thing they want to see is a double top on inflation and a double dip recession. So they want to put it down, and they want to put it down for good, right, when we're talking about inflation. So when they do start cutting rates, they're probably doing that in terms of fighting something, which is either a recession or deflation, which is not great for the economy, which is not great for the market in the short term, but eventually being a very, very good catalyst, and we do get a very nice window of buying opportunity during that time. Because at the end of the day, I mean, on the surface level, rate cuts are quantitative easing. They are a way of quantitative easing. They are a way of stimulating the economy, and that creates that window of buying opportunity, which eventually the market realizes, then it starts pushing higher. Similar to what we witnessed in 2020, similar to what we witnessed in 2018, similar to what we have witnessed in 2011, similar to what, like literally every single time we've gone through these rate cut cycles, the markets have reacted positively eventually. Maybe not in the short term, but eventually they have. So that was, the answer to that question. And now going over to some of these numbers. So this is the Atlanta's Fed sticky price CPI. So sticky price inflation, a measure of things such as rents and various services and insurance costs, ran 5.1% in September. So that's a little bit higher than the overall headline and core CPI as well, because these are stickier inflation numbers like insurance costs, rents, some of these other items that are considered to be more sticky than others. And we've got flexible CPI, which does include food, energy, vehicle cost, apparel, ran at just 1% rate. So you can kind of see like what really is the culprit, what's really moving lower, what's really actually moving higher, and it's rents and it's insurance services, some of the stickier items. So again, you can see shelter was up 0.6% month over month, 7.2% year over year. Food prices up 0.2% month over month, 3.7% year over year. And fuel oil, as discussed in our previous updates, 8.5% month over month, and still down, right? Still in deflation at the moment. So even though we are seeing deflation from energy, we're seeing disinflation from food, and we're seeing a very, very moderate disinflation from shelter, but it's not really showing signs of selling off pretty aggressively, so that to a point where inflation overall starts coming down. Now, another report, mortgage rates hit 23-year highs, and home prices show few signs of cooling. So again, we talked about this, during our live stream as well, that this is the widest gap, one of the widest gaps that we are witnessing between the buyer and the seller when it comes to real estate. And it's unfortunate because mortgage rates are hitting their highest levels and the cost of borrowing is extremely high, right? And until that market normalizes a little bit, I think rents are going to be under pressure. Now, this right here is the state of the market. So big tech was flat, right? We didn't really see a lot of momentum in either direction. Meta here down, Google down 1%, Tesla's down over 1.5%, Apple's down half, Microsoft's down 38 basis points, Amazon's up 38 basis points, Broadcom, we did have semiconductors push higher, so Clack Corporation, Lam Research, Applied Materials, Broadcom, Adobe, they all pushed higher a little bit here on the day, but overall, we did have a lot of stocks selling off, including medical devices, diagnostic research, medical instruments. I think a lot of this sell-off could also be regarded to InMode. InMode was down over 20%, but InMode is not such a large corporation to take down a lot of these companies. But there was this overall consensus of negativity on the medical device sector because InMode came in with a lower guidance for their third quarter and full year fiscal year 2023. And as a result, they obviously did. They were down over 20%, and some of the medical device companies were also selling off here on the day. So energy was the only sector that was somewhat positive. Everything else was down. In the last 1 week, we've seen consumer defensives definitely selling off. This includes your food and beverage companies, including McDonald's, Coca-Cola, Pepsi, all these companies that were selling off on the back of that weight loss drug and the report that came out of Walmart's executive. But overall, everything else is higher. 10 out of 11 sectors green. And over the last 1 month, we've got most sectors selling off except for comm services. So Meta, Google, that are part of comm services, they're the only ones that are kind of holding up. Orange juice for the win. Look at that. Orange juice up over 2.6%. We got cocoa prices, coffee prices, gasoline, everything pushing higher with palladium, wheat, platinum prices, soybeans, corn, and lumber prices rolling over. Bitcoin still hovering over 26,000. Ether just over 1,500 as well. Now, this right here is the jobless claims that I also wanted to talk about. And jobless claims numbers came in at 209,000. And that is a very, very important indicator to watch, right? It's a leading indicator that basically tells us when there is a possibility for recession to start. Every single time jobless claims have climbed above a certain threshold, unemployment obviously has followed, and that eventually has led to a recession. So the level that I'm really paying attention to right now is going to be closer to 300 to 400,000 claims, initial claims on a weekly basis, because that tends to be a very, very concerning number. You'll notice that majority of the times we actually are below that 400,000 threshold, but the moment we start breaking above, a recession has almost always happened. So you can see that this right here, breakout over 400,000, recession took place. That was actually during a recession. This right here, as soon as we broke out about 400,000, recession. We were above 400,000, recession. We broke out over well, this right here, maybe not so much. A couple times we kind of broke above 400,000. That didn't quite lead to a recession in the 1980s. This right here, most certainly in the 1990s. Again, just a few times you kind of broke out over 400,000. Didn't quite see it as concerning. This right here, again, in the early 2000s, late 1990s. Again, over here, 2007, 2008. And right now we're nowhere near close to that 400,000 level just yet. So very, very important and leading indicator for us to pay attention to from an economic standpoint, from a labor market perspective. So going over to the S&P 500, you can see that we did sell off here 62 basis points. So we actually came down to 43.25, 43.20. So this right here is actually going to be a reasonable support for the S&P, kind of validating that support and then pushing right back up a little bit back under 43.50. But nonetheless, we did pull right back down. And as I mentioned before, we're not out of the woods yet, right? That's exactly why I wanted to mention that we are still very much in the context of this downtrend, lower highs and lower lows. Yes, we got a very nice bounce from that 4,200 level, from that 200 simple moving average. We took a nice trade on TQQs. We took a nice trade on defense, aerospace, defense sector. But just looking at it from the perspective of whether we have more upside, we may do have more upside here, but 44.50 is going to be that level. That lower high is really going to be that resistance for S&P moving forward. So this right here is going to be that level. And if we break out above 4,500, that's when I'm going to be a lot more convinced that, okay, there is more upside. There is higher highs and higher lows possibility for S&P 500. But until then, there is still a possibility of this lower highs and lower lows continuing for the pattern. That's really where we are. That's really how we're trading. Volatility here was up over 3.7%. So again, a very, very muted move to the upside, 16.7. So resistance is going to stay put at 18.5, closer to 19 levels, all the way up to 20. Bitcoin here just selling right back down, a little bit over 26,800 at the moment. Still inside this uptrending channel of higher highs and higher lows right now. So that's what we're watching. And Ether also just consolidating sideways at the moment. Support level, very strong support, sitting roughly at around 1,100 to watch for Ether as well. 10-year yields, we're on the move. 4.68% is where we are. Mortgage rates are getting up to over 7.5 for 30-year, 15-year, sitting at just under 6.9. So again, we continue to see a very, very massive move. In interest rates, yields are kind of moderating a little bit, and that's exactly one of the reasons why we do have a position in TMF and TLT. TMF, down 8%, pretty brutal here, selling off quite aggressively. The 10-year yields had a very massive day, right? So they were up a little bit over 3%. 3% for the yields, pushing back over 4.6, 4.7. And of course, as a result, TMF was down a little bit over 8%. So a very, very significant move to the downside for TMF and TLT as well. We'll talk about this in more detail in one of our other videos. So next up, going to this is going to be Apple. Let's just go over to the NASDAQ first. And NASDAQ here also rolling over 60 basis points, again, kind of bouncing off of that support at 13,100. We've had 3-4 consecutive green days, and now we're kind of approaching that lower high for the NASDAQ, and that's really where the bears are going to start to step in, and it's going to get really interesting whether we get rejected or we break past that resistance. So this is going to be that lower high. That's the level to really be paying attention to for the NASDAQ moving forward. Apple here, on the other hand, again, you can see that we are perfectly in that lower high. So we are testing $179, $180, and this is the lower high. That's where we are at the moment, very much in the context of this downtrend. Now, if Apple breaks out over 180 and continues to see that uptrend, the next resistance is going to be somewhere over here at 189, closer to $190. And if Apple can break out of this downtrend, that is going to be very good. That's going to obviously put more pressure, more upside pressure on the markets and the S&P and the NASDAQ. There is a possibility that they also continue to move higher as well, and of course break out those trends. So Apple here, again, we've got that lower high sitting roughly at around 181. That's going to be that resistance level to watch. Talking about Amazon here, almost filling this entire gap. So we've got a very, very, very small gap left here, but pretty much selling off from highs of 134, coming back down to 132. This right here is going to be that lower high, something that we have discussed in our previous updates. That's the lower high and the lower low for Amazon, and support level is going to stay put roughly in the 120s, 125, 124 for Amazon. Talking about Tesla here, and Tesla here, once again, you can see literally just getting consolidated and selling off from that resistance of around 269, 270s. So support level is going to stay put roughly around 256 for Tesla, and right now we are very much in the context of this little bit of that symmetrical triangle that's kind of starting to form, where what you'll notice is that we are getting rejected at these lower highs, but at the same time, we're getting validated at this higher low. So what we are really seeing is a lot of consolidation, and the pattern continues to coil in, and I think it's going to be ready for earnings. I think earnings is going to be a big catalyst for Tesla for us to see whether it breaks out or breaks down. But right now, down 1.5% on the day, getting rejected 2 days in a row, as mentioned in our previous market updates, and right now coming down to its higher low at 250. So it's kind of coiling in to make a very, very massive move very soon. Talking about PayPal, and PayPal here, yet another low, down almost 3%, so continues to sell off here, still trading in the context of this lower highs and lower lows and this falling wedge pattern. Earnings is what's really going to matter with the new CEO and their vision and what they're planning to do to kind of, restore some confidence, some investor confidence in the future. But right now, definitely selling off almost 3%, $56. This right here is going to be that support level. And of course, we got a resistance sitting all the way up to 65 to as much as $70 per share. So I think it's just a waiting game right now for PayPal. Square, on the other hand, has had a very nice reversals in the last few days. I am taking suggestions, folks. I think Square and Shopify, we're going to drop out of these market updates and we're going to replace them with a couple new stocks. So it's a pretty big decision because we analyze them on a regular basis. So I want you guys to take that seriously. And there's been a lot of great suggestions in our Discord. So let us know in the comments if there's any companies you think are going to be good fit. They need to be profitable, right? We've got the same criteria as the S&P 500, so they need to be profitable. They need to be more well-established companies, companies that people are going to be interested in, people that they know their products and services. So let us know in the comments which companies can be replaced for Square and Shopify. They're not profitable yet. And they're just like having a very hard time kind of executing on their strategy, and it's been all over the place. So we're going to drop them out for two new stocks, two new companies that I think would make more sense, given that we can analyze them every day. So let us know in the comment section down below. But Square here, $45 where it's at. I mean, it's obviously been selling off. Bank of America, I think, came out with a report that this fintech stock has a 60% upside. Again, eventually we'll find out if that actually ends up happening, but $52 is going to be that resistance right now. And we've got a moderate support at around $40, $41 per share. Talking about NVIDIA, and NVIDIA here pushing higher, got rejected a little bit at around $476, $480. So very, very nice move to the upside for NVIDIA. It's pretty much trading at an all-time high. So NVIDIA, I mean, all hail NVIDIA because it's just done incredibly well throughout this time. And it's just been consolidating sideways with a massive support at 400. And a resistance sitting in the 480s and 500 for NVIDIA. Talking about advanced micro devices, also getting a little bit of that rejection at 112. So this right here is a resistance to watch for advanced micro devices. And right now we are, once again, getting a little bit of that resistance there, and support level is going to stay put at 99, close to $100 per share for advanced micro devices. So this right here, lower highs and lower lows, a falling wedge pattern. We got a very nice breakout, a little bit to the upside, but we're not making that higher high yet. No higher high in sight for AMD just yet. Support level is going to stay put at 99, closer to $100. Meta Platforms, getting a little bit of that resistance. We did get a decent breakout. So in theory or in technicals here, yes, we did make a new higher high, but the price itself also is a bit more on the overbought side. It's kind of funny because this is actually one of the fewer names that's actually overbought right now, with RSI and MACD here pushing higher, and support level is going to stay put at 310 to 312s for Meta Platforms. Talking about Netflix here, Netflix continues to slide lower, so we are starting to see more breakdowns here for Netflix, now trading below its 200 simple moving average, and the next support is going to be 332. So this right here is going to be that next level to watch for Netflix moving forward. That's going to be that level. And Google here, also pulling back, although validating that support at 139.140. So low for the day was 139.45. and we validated that support before pushing back up to 140, and resistance is going to stay put roughly at 144 for Google. We still have a little bit of ways to go, and the all-time high sits roughly around 151. But Google has done really well year to date. The stock's up over 56%, so incredible gains for Google. Microsoft here, again, just consolidating sideways, so not really moving all that much. Down about 38 basis points. We got a huge resistance sitting at 340, and a support level is going to stay put at $311, $312 per share. I would still argue that it's still very much in the context of this downtrend of lower highs and lower lows, and we're not broken out of that yet. Going over to Enphase Energy here, Enphase also pulling back from that resistance of 128, 129. So this right here is a resistance to pay attention to for Enphase, and this is really where that good deal area kind of sits for us for Enphase. And finally, Shopify pulling right back down. This is a gap that it eventually needs to fill in, and we've got a support sitting roughly at $51 per share for Shopify. So I hope you guys enjoyed this video. Don't forget, we've got the MoneyVest stock reports, we've got the members-only private videos, and the Excel spreadsheets, all of that available, including the buy and sell alerts. Everything's going to be a part of our MoneyVest community. Make sure that you do join. I did open up a couple more spots. As always, if you have any questions, feel free to reach out. Let us know what two stocks we can actually replace for Square and Shopify. And as always, happy investing, and I'll see you all in the next video, and the links are going to be down below.